Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly recap of all the latest going-ons in the mortgage industry. Each week, I am pleased to be joined by one of our lender members as my co-host, and this week, back in the co-pilot seat, the Vice President of Mortgage Lending for Trulia Credit Union out of North Carolina, Beth Eller. Beth, great to see you.
Thank you very much, Rich. Great to be here.
Awesome.
Looking forward to today.
Cool. And always like to level set with our audience. If you could tell us a little bit about Trulia Credit Union, the mortgage operation within it.
Absolutely glad to. So Trulia is a credit union based out of Winston-Salem, North Carolina. We have about 35 branches stretching through South Carolina, Virginia, and North Carolina as our primary markets, and have a wonderful mortgage group here. Like most everyone in the mortgage business, had a really good year last year, continuing into this year. Looking to try to figure out how to grow that out some more in 22. But it's been a fun couple of years, and really looking forward to what all is left to come. I'm kind of an optimist about it. I think we're in a good spot, even though refis are tailing off a little. I think mortgage lending is going to be good for a while.
And good segue as we get into the latter part of the year here, Halloween approaching, just a couple months left in the year. A lot of the news headlines these last couple of weeks really have been centered around a continued home price appreciation and also projections and forecasts for next year. Remember doing this show a year ago, trying to project that 2021, and I don't think, this year is going to be down a little bit from last year, but last year was the biggest year in the history of the industry. None of us expected the year that we had. How just this year, I mean, busier than what you projected at the beginning of the year by a good amount, right?
Oh yeah. We were a good 50% over budget, I think, at some points, and started to level out a little bit in the third quarter, and I think we'll see more of that in the fourth quarter. But you just can't predict those things. It's refinance booms are always a wonderful thing when you're in them, and then all of a sudden, when they start to dry up, you look around and go, okay, now what are we going to do? Where are we going to go from here? And I think a lot of people are starting to hit that stage, although there is still fairly robust refinance activity. It's just not like what it was. We feel good about it.
And as always, as we get into the show, any comments, questions, thoughts, anybody has, please feel free to drop them in the chat or the Q&A, and Beth and I will be happy to address them. Beth, let's get into the news headlines of the last week and breaking news just from a few hours ago. The Case-Shiller Index, really regarded as the national standard index for home price appreciation and home values. It looks at a 20-city and a 10-city index. The 20-city, the more notable of the two, and September to September, up 19.8% home values nationally year over year. That matches last month, August up 19.8%. But crazy. We've seen home values appreciate in America 20% over the last year. Is that consistent with what you're seeing in the Carolinas and Virginia?
Yeah, absolutely, it is. Of course, we have Charlotte, which is one of those 20 markets listed in that report, that metro area, and then the Research Triangle Park around the Raleigh area, both of those being dominating markets for us. And then you have like the Greenville, Spartanburg, MSA, and Charleston, those markets, all very robust and continuing to see that home price appreciation and all the things that come with that, the constricted inventory being an issue, and really questions around, how much higher can that go? What does this look like? And when you go year over year from August to August, you really have about a 1.2% growth there, I think, in what they predicted. And who would have thought that this would have come out and stayed this long? It's crazy.
It's crazy. I've been chronicling on this show. I bought a house this spring and was kind of terrified I might be buying the top of the market, but looks like, home values have continued to just move up all year, and it's just really a supply and demand thing. And some of the projections for home price appreciation for next year starting to come out. as well. Anything that's caught your note there from any of the big economists putting out their dart throws on home values for 2022?
Well, certainly, you can see Fannie's already out of the chute saying it's going to continue. And I read an article, I think from Reuters, saying 22% increase. I mean, everyone you read is still up double digits, regardless really of where you are. And that's hard to fathom too, that you're going to go up another double digit year with values and what that will do. So I guess that means you don't need to sell your house yet. You might be able to sell it next year and get even more appreciation out of it.
Yeah, Fannie, Freddie, MBA, all coming out with projections, and you got to take that kind of with a grain of salt because they, aren't in the business of, making over aggressively predictions, I guess, for lack of a better way to put it. All predicting home values to appreciate like 5 to 8% next year, but then almost everybody else, Goldman Sachs was 16 point something percent. Zillow, I think, just revised their home appreciation projection for 22 up from like 11 point something percent to 13.5% for next year. And just because it doesn't seem like, it seems like demand is strong to buy houses and that there's really nothing looming on the supply side that is going to meet that continued demand. And that's good old American economics. Supply, demand equals markets equals prices.
Well, it does, and I think the one big question that a lot of us have right now, Rich, is, the impact on the first-time home buyer. There are several articles out there about that as we have investors that continue to buy in that starter price range, and people are struggling to find those houses now because there's just not that inventory out there. And I wondered your thoughts about that.
Yeah, I mean, there's all these reports we're getting, about home values. Great if you own a home, but if you don't own a home or need to buy a new one, not so great. And kind of lost in these numbers is the percentage of new and existing home sales every month that go to first-time home buyers. It just continues to decline. I think the statistic, it was existing home sales were up 7% in September from August, which was a very optimistic number. Nobody was projecting that big of a jump, but just 28% of existing home sales nationally in September were to first-time home buyers. That was the lowest percentage of existing home sales in any 1 month since July of 2015. So, and that, we've talked affordability, clearly an issue right now in the housing industry. And that's what 30-year fixed rates at 3%. I mean, envision the scenario where, as MBA now has projected, that 30-year fixed rates will go to 4% by next fall, what that would do to affordability.
It does have it has a tremendous impact on it for that first-time home buyer level, which then is what pushes everything else up, as we know. The move-up buyers looking for someone to buy their home, and investors can do that. But if you don't have first-time home buyers buying, then you really have a problem there. And I think also, if you look at those numbers, the amount of those loans that are going to FHA and VA, some of the more traditional type of first-time home buyer loans is down as well. And in fact, in a lot of the markets that we're in, real estate agents really are sellers, don't even want to entertain a government loan offer because they know it's going to take longer with more paperwork. And so I think that's being negatively impacted as well.
Yeah, certainly something for likely incoming FHA Commissioner Alana McCargo, great gal that we've had speak at some TMC events in the past. Think she'll do a great job in the role, but a kind of a tricky situation she's inheriting, because we hear the same thing from our members all the time, that the referral partners, the real estate agents, it's such a competitive market with the restricted number of purchases and the value of where they're sending that referral and that loan. Like, they don't want to hear FHA and VA. And for all the reasons you mentioned, that's a very real part of the market right now.
Yeah, I don't know how you fix that really either until the inventory issue starts to level out some. You've just got to have more opportunity for those buyers. And I don't see that anytime in the near future. Certainly, I don't think any of us do.
Yeah, I know one of the things that has been talked about in the past is maybe some sort of reduction in the mortgage insurance premiums on FHA loans. I haven't seen anything recently on the health and size of the FHA reserve fund, but as of the last time I read something 2 or 3 months ago, it was over reserved. It was in a very good spot. Could lend credence to the argument to lower those premiums to make those programs more viable. In theory, that would also take a little of the weight off of Fannie and Freddie that are going to be involved in a lot of new first-time home buyer programs and affordable goals related to, or higher goals related to affordable lending and minority lending. So,
Right.
so keep an eye on as we get into 2022. But because you're right, Dad, and we've seen that in TMC benchmark every month, the percentage of closed loan units that our government has slowly subsided throughout the course of the year, and really throughout the pandemic for that matter.
I wonder too what effect that'll have on some of the independent mortgage bankers that do such a high percentage of volume. I guess they've got to compete more so in the conforming market, whereas in the past they may have been a stronger government lender, and what impacts that may have as well.
And being honest, they're more profitable loans for mortgage lenders as well. And as we go into a new era, a new hopefully post-pandemic era of mortgage lending. Again, MBA and others projecting a pretty significant drop off in volume next year. MBA, I think, is projecting 2.6 trillion. This year is expected to come in at 4.1. That's a big drop off. Doing the math, my head's 40%. I don't know. When you get that kind of drop off in volume, you also are going to get a drop off in margins because people are going to compete more intensely for that business. So another just real world part of like the conventional versus govy balance and mix part is, government loans they help mortgage companies operate more efficiently and profitably.
Absolutely, they do. And I think another component in the supply issue is there were so many predictions that all the loans that went into forbearance would turn into foreclosures. And I think we've seen that's really not the case. Forbearance numbers continue to decline as well. And certainly there've been a lot of them, but it was not the massive wave that people predicted. And, that's contributed to the inventory issue as well.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, joined this week by Beth Eller, the Vice President of Mortgage Lending for Trulia Credit Union. And Beth, that's a great point. We've talked about this for the last few months now. All the forbearance programs ending, all these homes coming out of forbearance. What would happen? Are we going to have this, surge of foreclosed homes hit the market? And it turns out that what has happened is what we kind of suspected was happening is the majority of people in the forbearance program were able to pay and just weren't because they didn't have to, it seems like.
Absolutely, that's true. I mean, we've seen a lot of the applications that we have come in where someone's in forbearance and we'll say, well, I'm sorry, you got to make 3 payments before we'll refinance your loan for you now. And they said, but I didn't need it. I didn't have to do this. I just did it by choice. And so I think there was some misunderstanding around the program itself too, but a lot of people could afford to make their payments and just chose not to. And then it helped a lot of people as well, without a doubt.
Absolutely. So the Fed getting ready to taper their mortgage-backed security purchases. They've really done a great job telegraphing and laying out how they're going to do this very systematically and methodically. And I just posted actually a great short 2-minute video to my LinkedIn feed. If anybody wants to take a look at it, Chris Bennett of Vice Capital Markets, a really intelligent guy and longtime partner at TMC, put together a great little 2-minute video just talking about like, what does this mean? What does taper mean? And what happened the last time the Fed tapered mortgage-backed security purchases, and how exactly is it likely to impact mortgage rates in our industry? Worth the watch if anybody's got a couple minutes, but I think most people projecting a slow, steady increase to 30-year fixed rates over the course of the next 6 months as a result from, where we are today, which is around 3%, right? Today, 30-year fixed, somewhere in that ballpark for prime.
Yeah, absolutely. Well, and Chairman Powell said too, he didn't intend for this to be a sharp increase in rates. That's not the goal. But more of a tapered approach. And so we'll see how the market reacts to it.
Yeah, the Fed's done really a great job, especially this one under Jerome Powell, really, telegraphing, laying out. Last thing the Fed wants to do is shock markets, surprise people. Kind of almost the opposite of how the old FHFA was working. Like, hey, we're changing this and it's effective tomorrow. The Fed taking a very proactive and telegraphed approach to their monetary policy. And, I don't think anything to worry about, something we knew was coming. The Fed cannot continue to buy 40 to 80 billion dollars a month in mortgage-backed securities. And largely, I'd say that that program has been successful. It's kept rates down. It hasn't shocked markets. The Fed balance sheet has not exploded like some people feared, and been generally effective. No?
I think so, definitely. And I also think it's helped with that home affordability issue as well, and keeping rates low so that homes could be more affordable even through the increase in prices. And I guess that's one of the concerns that we all have is if those rates start to inch up even at a tapered measure, what does that do for the home affordability index and people that are trying to buy houses with a constricted supply? That kind of feels like a double whammy in there. If you get an increase in rates and you've got a constricted supply with increasing prices, how do we work our way out of that?
That's a great point. When you hear a stat, the only 28% of existing home sales in September were to first-time home buyers, the lowest number again since July of 2015. What would that percentage be if the Fed was not buying massive amounts of mortgage-backed securities and really manually keeping rates low, and 30-year fixed rates were at 3.5 or 3.7 or 3.9? Certainly lower than the 28% that caught some eyes here in September. And a great point.
I just wonder about the economy in general too. We've had such an artificially low imposed interest rate environment, if you will, from the Fed. And I think people want the economy to be better, and so we'd like to see things to improve. But is raising rates gonna help the economy in the long run? Where's that tipping point of, okay, that's enough now, and now you're cooling us off? What will they do? Watching for that to see when they need to hold with increasing rates kind of at a gradual pace until employment can catch up, and you get rid of the COVID fears out there, and the economy's kind of really running full swing.
Yeah, it's really a fascinating, high stakes kind of puppeteer game of pulling the strings on these big monetary policy decisions. And, previous Fed chairman, going back to Greenspan and Bernanke, caught criticism for their perceived role and some of the disruption to the financial markets. But I would say all in all, man, given this pandemic and just the insanity that has ensued the last year and a half, all in all, I think the Fed has done a pretty good job pulling the monetary policy strings throughout all of this, evidenced by the fact that we have not had some sort of calamity, and stock market's in a good spot, and
I agree.
the economy is recovering and starting to kind of hum again, despite some continued pandemic headwinds.
I agree. Now, if we can get supply chain disruption figured out, we'll all be in good shape for Christmas, right?
I've yet to hear any news. One day on this show, I want to talk about something that's going to help the supply issue in this industry. Like everything that's being bandied about is to create more demand in a market that is chock full of it already. But we'll see what happens here. Beth, moving on, just the new iteration of the CFPB making a lot of headlines. And, it's not anything new. I think it's just because the previous version of the CFPB, it was definitely a different MO. Talks, we've had an enforcement action against the bank on redlining that obviously caught a lot of people's eyes. Haven't really seen any of that the last 4 or 5 years during the Rich Cordray CFPB under Obama. We saw some of these, the kind of regulation by enforcement action, but I think this CFPB doing a better job trying to telegraph what they're looking at and the behaviors they want to see. But just general thoughts on the new, old regulatory environment. The topic of redlining in general is a depository institution. I know our depository members, this is kind of like old hat to them, something they're, have from their bank and credit union regulators, been trained to keep an eye on over the years.
Right.
But your thoughts on the issue in general?
Well, I think we all know that redlining is wrong and is something that should not occur, regardless of what type of financial institution you are. And I have found in my short time in a credit union, it is a little different here than I spent a lot of time at banks and at independents as well. With banks, it is inherent in everything that you do. And in the credit union world, you have a more specified membership that you're serving. And so it's a little different. And then of course you have your independents that aren't really regulated in the same way. And this talk about regulating independents and holding them accountable to the same standards that depositories are held to when they don't really have the ability to access some of the programs. They don't have deposits. That's an interesting play with that. I understand the need for it because I think, again, redlining is just wrong, but how you place the same regulatory burden on an independent that you have on financial institutions is a bit interesting to me, along with all that. But you would think with the pent up demand for housing, redlining really doesn't make sense then, because regardless of what market area you're in, there's a demand for housing for people to buy affordable housing, certainly. So I'm a little confused by that, but I think the CFPB reemergence is no surprise. They have given us warning it was coming. You could look at the people that were appointed and know that we were going to move back into a more regulated environment than we felt in the last few years, I think.
Yeah, great point. So that's what a lot of members are saying to us, like redlining, like we want to make loans like for anybody that can qualify to these now widely publicized and reasonable underwriting guidelines. And
Yeah.
first time home buyer loans are typically a lot of times FHA, VA, they're more profitable loans for mortgage lenders. They're insured by the federal government. They're not even loans that lenders service in more cases than government loans. So, it seems a little to do about nothing. But your other point about like, should independent mortgage banks be held to like CRA standards? It's a big topic right now. And it looks like the state of New York is, and we have a lot of IMB members in New York and some that are very involved with MBA, that this is a big issue for MBA.
Sure.
And what MBA is saying and what those IMBs are saying is like the CRA Act is an act that was put in place for banks to lend back out money where they're taking deposits, because that's an advantage. They're insured by the FDIC. And IMBs are like, we don't take deposits, and we do the vast majority of the government loans in America. So like the IMB members, I think rightfully are kind of up in arms in this, but it looks like New York is poised to bestow those CRA restrictions on independent mortgage banks in the state. So
That's going to be interesting to see them try, like I say, and enforce that as well. And how can you really do that when it's Community Reinvestment Act? So if you are a transactional lender and you're making mortgage loans, you certainly have responsibility around fair lending. But how can you reinvest other than to make more loans in a market? You don't have a depository tie. So I think that's a real conundrum to me and where they're trying to go with it. We all would like to see a level playing field where financial institutions would love to see that we're all audited and regulated in somewhat of a similar fashion. But I'm not sure that I think that's the right way to approach it. I think that there's a bit of overreach there. Lending practices you can measure, and we can all measure each other the same way that way. But to apply CRA to a non-depository is a pretty difficult way to measure fair lending, in my opinion.
this is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative, this week joined by Trulia Credit Union's Vice President of Mortgage Lending, Beth Eller. We've got about 5 minutes left with Beth. Beth, RE/MAX did a big national survey recently of prospective and existing home buyers, taking their temperature on a lot of things. A lot of it was related to like online tendencies and the results were not surprising. 94% of Americans are using websites, phones, mobile, online platforms to search for homes. Not a surprise there. And then comparing generations of baby boomers and Gen X and millennials, and again, not surprisingly, large percentages of younger people find communicating virtually, in many cases even viewing homes virtually, the younger the buyer, the more okay with that they are. And just, I 5 years ago, I remember people talking about like the death of the real estate agent and the death of the mortgage loan originator. And,
Oh, yeah.
here we are 5 years later, and more things are online, but I don't think there's less realtors, maybe. Yeah, I don't think there's less mortgage loan originators. How do you see just the future of that playing out?
I think at the end of the day, people still want a human touch to it. And I believe that was one of the points of the article that it continued to bring back around, was that a buyer would use the electronic or online methods to look at homes to do things, but somewhere in there, they wanted a broker opinion. They felt like there was value to having a person to talk to. And I think that I certainly would like to believe that the same is true for mortgage lending. Trulia has been a leader in doing fully electronic closings in the state of North Carolina. So we'll do an end-to-end with an e-note and everything in it. And we find that even in that process, it's important to have that human connection. People want to see you, they want to know you're there, they want to have an attorney present. Even if it's by virtual, we all, thanks to COVID, have gotten used to the Zoom, or WebEx or whatever, you use to deploy that. But people still want to know there is a person that they can talk to. Certainly technology will push us forward. And how cool is it to go online and look at a house and be able to go, yes, no, yes, no, yes, no, and mark your possibilities down. But I think most people still would like to have the opportunity to go in and actually look at it and see what it looks like. You can hide a lot on video.
It's true. Exactly. Yeah. Like the mess I have like right over there.
That's right.
North Carolina, one of the states that has been full e-close, right, for a while. And
Yes.
like our conference a few weeks ago, like it still boggles my mind that we are still talking about e-close, like we're not e-closing loans yet. I sign electronically for everything, but a lot of that is the legislative piece, and states, unlike North Carolina, which if they've not fully approved remote online notarization, but in general, like full e-closes. How has it gone in general for Trulia? A lot of people worry like older home buyers, or are they going to be opposed to it? What's your general just experience been with full blown e-closes?
So it's been good overall. We are still not fully RON. We are Ipin, and we have an emergency video notarization bill that was passed in COVID. The RON legislation's getting there, but even with Ipin, we've seen good adoption with it. And we do have certainly for ourselves clients that don't know how to e-sign their disclosures on the front end. So if they can't do that, they're probably not going to be real successful with a e-closing as well. So we kind of try to measure that out. But by and large, people are used to e-signing for everything. If you go buy a car, you're going to e-sign for it. Just about anything you buy as a consumer, you do electronically. And we feel like it is a better delivery to the consumer because we get that package to them sooner. They can review it. They can't e-sign it until that day. They can ask the attorney questions well in advance. It just seems to be a smoother delivery process than going in and sitting somewhere for an hour and a half to 2 hours to sign paperwork. And we still need our attorney partners, and we're not trying to cut them out either. We want them, obviously we have to have them at attorney state, but we want them to be as involved as they can be. But I do think consumer demand is really growing for a full e-closing process, and it seems to really be finally taking off. We're very excited about it here.
I mean, it wasn't that long ago where like people were freaked out about like putting your credit card online to buy things. And now it's, I mean, the norm. If I couldn't buy things online, I wouldn't even know how to go back to like going in the stores for everything I needed now. But
That's right.
and it seems like, that the whole e-sign thing, is kind of like in the same vein. Like we'll be looking back at it laughing that it took this long, but
I think so.
Beth, any Halloween plans or anything this week? It's starting to get cold, at least where I am in Cleveland. I'm looking outside and it's like rainy and like 40. You probably got it a little nicer in North Carolina, right?
I don't know. I think it's supposed to rain towards the end of the week, but in Winston-Salem, North Carolina, we're all excited about one thing, and that would be the Wake Forest Duke football game on Saturday. So
Ooh, that's right.
Yeah, we've got undefeated Wake Forest, which is a very unusual thing for Winston-Salem. So we're going Go Deeks.
Demon Deacons having a hell of a year. And yeah, and then you're, with apologies to our members in Indiana that I know I'll get hate mail from, the college basketball really hotbed of America, North Carolina. I mean, that it's going to be nice to see jam-packed arenas again and things getting back to normal down in the Carolinas for not only the end of the college football season, but all the college hoops action we got coming up as well.
Absolutely. Absolutely. Can't wait for the hoops. I think Wake Forest football had a basketball score last weekend with a 70-point win. So who sees that in football ever?
Good stuff, and good luck to your Deeks this weekend. And to all of our attendees, thank you as always for spending 30 minutes of your week with us. We are here every Tuesday from 2 to 2:30 p.m. Eastern live. And then, of course, release this as a podcast where I know most of you listen, and release it also to our YouTube channel where you can watch the videos after the fact. But Beth, thanks again for joining me this week.
Thank you. Always a pleasure.
Happy Halloween to you, and we'll see everybody again next Tuesday on the last week in Mortgage Today. Have a great week, everyone. Take care.